This is a video for Finance 438 Management of Financial Institutions at California State University, Northridge, and I'm Jim Dow. In this video, I will cover Chapter 16, and we will look at some of the other lending institutions, such as savings and loans and finance companies. There are other institutions in the U.S. that make loans besides commercial banks. Historically, commercial banks focused on making loans to businesses. That's where they get the name commercial. So other institutions developed to provide opportunities for individuals to save and borrow. An example of this was a building society, where a group of people would pool their money and then some would be given loans to buy a house. As these people repaid their loans, others of the group would then be given a loan. These institutions were an example of mutual institutions in that they were owned by the depositors. What institutions like these had in common is that they focused on individuals with only a small amount to invest, and they gave them an opportunity to save their money, that is, to be thrifty. That name survives to this day, where we call them thrift institutions, or thrifts for short. There are two broad kinds of thrifts: savings banks and associations, and credit unions. You can still think about these institutions as being banks. They take deposits and make loans, but they operate under different rules and regulations, which we'll talk about in more detail shortly. Another type of institution that makes loans is a finance company. Finance companies differ from banks in that they do not take deposits, but rather they raise money by borrowing. Finance companies are sometimes categorized by who they lend to and what they're lending for. So we see consumer finance companies, sales finance companies, and business credit finance companies. Savings institutions go by many different names, including savings and loans, savings associations, and savings banks. Some of this represents legal distinctions or regulatory difference, and sometimes they were just different names in the past. Before 1980, these institutions were regulated quite strictly, with the goal of providing a safe place for small savers. They could offer slightly higher interest rates than commercial banks to allow them to attract depositors, but they were limited in what they could do, and the expectation was that most would have a focus on mortgage lending. There are several regulatory agencies for these institutions. The one you need to know is the Office of Thrift Supervision, which regulates thrifts that are chartered at the federal level. The primary assets of savings institutions are real estate loans, although they also may make commercial or consumer loans. These institutions may also hold mortgage-backed securities. Liabilities are primarily deposits with an emphasis on smaller depositors. This can result in the institution with having a maturity mismatch between assets and liabilities. If interest rates rise, the cost for the institution of the short-term deposits will increase, while the revenue on existing mortgage loans stays the same, putting the institution in a bind. This led to a number of institutions making increasingly risky real estate loans, and when they ran into problems in the late 1980s and early 1990s, a large percentage of these institutions failed in what was called the savings and loan crisis. Credit unions are mutual institutions where members pool their savings and lend them to one another. Unlike other lenders, credit unions have tax advantages in that they do not pay federal taxes on their income. For smaller investors, credit unions often offer higher rates on savings accounts and lower rates on loans than they could get elsewhere. All members of a credit union must have something in common called a common bond requirement. This could be working for the same company or belonging to the same union. This requirement has been interpreted more loosely in recent times. Credit unions are regulated at both the state and federal level. The regulator at the federal level is the National Credit Union Administration. Like Savings Association, credit unions focus on smaller depositors, but historically have had a focus more on consumer lending rather than mortgage lending, although mortgage lending has increased in recent times. Auto loans also make up a significant part of their lending. Commercial banks, savings and loans, and credit unions all have a similar balance sheet structure. They take deposits and make loans. And so they all fit the idea of what your average person thinks of as a bank. Finance companies differ in that, while they make loans, they don't take deposits, but rather raise funds primarily through borrowed money. So in common language, a bank takes deposits and makes loans, and a finance company borrows money and makes loans. Commonly, finance companies specialize in a particular kind of loan. Sales finance companies make loans to individuals to buy a particular kind of good. Captive sales finance companies are owned by the company selling the good. For example, if you go to a Ford dealership to buy a car, a finance company owned by Ford will offer you a loan to buy the car. Consumer finance companies are independent lenders that make personal loans to consumers. Since these loans are for smaller amounts and may be made to individuals with a poor credit history, the interest rates can be higher than on other loans. Businesses are often in a position where they need to buy their inventory now, but won't have enough money coming in until the consumer buys the goods and pays for them. A finance company can lend the business the money to buy the inventory, which is called wholesale paper. If a company has accounts receivable, that is, it sold a good but has not yet received payment for it, a finance company could buy that account receivable from the company at a discount. Since the finance company gives the business the money now, and then will receive a larger amount of money later when the account receivable is paid, this is effectively a loan. This process is called factoring. Finance companies raise money through borrowing. Most of this borrowing is short-term borrowing, such as commercial paper, which is part of the money market. This produces a maturity mismatch. For example, a finance company might have made a 4-year auto loan and financed it by borrowing with a 1-year loan. When the year is up, it must find a new 1-year loan to replace the old. In 2007 and 2008, wholesale lenders became concerned about consumers defaulting on their loans, and were very reluctant to make these loans to finance companies. In casual language, the money market froze up, which put the finance companies in the difficult position of not being able to raise money. Regulation of finance companies focuses more on consumer finance and personal loans. This is because they are smaller borrowers and are less likely to be financially sophisticated. Regulations may include what information must be disclosed and how it is presented. There are also usury laws that limit what interest rates can be charged on a loan. These limits are called rate ceilings.